Which one of these is the best growth stock to buy? Shopify, DraftKings, or Palantir Technologies? I'm going to evaluate these three growth stocks across four separate financial metrics and answer the question at the end of this video, which one is the best growth stock to buy. So you're not going to want to miss that. Let's get started looking at revenue. Shopify, of course, the online e-commerce enabler, absolutely thrived ever since the onset of the pandemic, with revenue absolutely exploding all the way up to 1.735 billion in its most recent quarter. And longer term, online sales as a percentage of overall sales is likely to continue rising. Shopping online is just so much more convenient than shopping in person. Those advantages are not going to be made up by brick and mortar retailers. So Shopify is going to benefit from this long running trend for the next several years, perhaps for at least the next decade. DraftKings also has been booming in revenue as it's been gaining access to more new markets. The online sportsbook and iGaming and daily fantasy company needs approval before it can operate in each individual state. And it's been making good progress in entering new states, and that's allowing revenue to explode as it gains access to more new customers. Meanwhile, Palantir, the data analysis data optimization company that uses enterprise data to offer solutions, has been growing, and especially its business with governments is increasing. Now it's growing its base of commercial customers. Still, it's in its it doesn't have very many customers because it's just so expensive to employ its services. However, it's making progress in becoming more accessible, and its services are obviously valuable enough where existing customers have continued increasing their spend with Palantir. All three of these companies overall are growing and are expected to continue growing for several years into the future. The next thing I wanted to compare these three growth stocks on is cash flow from operations. And looking at this metric, Shopify is very volatile, up and down in the most recent quarter at 255 million. I I'm a little less optimistic about Shopify's cash flow from operations going forward because it has chosen to invest billions of dollars in rolling out its fulfillment network. That's going to prove to be costly. If we look at Amazon as an example, Amazon's fulfillment network was very costly to build out, and it returns very thin profit margins and cash flows in response. So I'm not as enthusiastic about Shopify's cash flow from operations. Next, we have Palantir that generated 78.76 million in cash flow from operations in its most recent quarter. And if we follow the light blue line, we could see it's making very good progress upward in this metric. And I suspect as the company continues to expand and scale higher, it's going to increase its cash flow from operations further. Lastly, DraftKings is negative in this metric at 148 million of losses, and I suspect DraftKings will continue experiencing losses in cash flow from operations so long as it needs to continue expanding into new markets. Right now, it's still under 20 states available for online sports betting. DraftKings is trying to get into way more states, so it's going to continue on that. And it's only in 5 states in terms of iGaming. It really wants to expand on that as well. So it's going to continue investing in growth, continue investing in new markets, and that's going to lead to cash flow losses for several quarters, certainly, and perhaps even several years. The next metric I wanted to look at is operating profit margin over the trailing 12 months. And in the lead here is Palantir at negative 8.46%, and it's been making very nice progress in its operating profit margin. In fact, Palantir management said that it expects to be GAAP profitable in its current fiscal year. So I wouldn't be surprised if we look at this metric next year and it's positive if the company delivers on its promise. The next, Shopify at negative 14.68%. It did become profitable for a couple of quarters before it chose to invest the billions of dollars into the fulfillment and logistics services. If you've been following my channel, you know I have not been a fan of that decision by Shopify management. Although longer term, that may turn out to be a smart investment. For now, I'm just not a fan of it because it's very risky, and I'm looking at the comparison with Amazon, like I mentioned earlier, and I don't see very much in terms of a reward for taking on this elevated level of risk. Again, I could be wrong, but I'm this is not a risk that I would want to take if I'm looking at investing in Shopify stock. And then finally, DraftKings, it's been making progress, but it's still significantly negative in terms of operating margin at negative 67%. And for the same reasons I mentioned for cash flow, DraftKings operating margins are likely to stay negative for some time until it reaches maturity, and then you can expect it to be healthy in terms of operating profit margins at scale, because it's essentially a platform that a gambling platform, and you've heard the saying, the house always wins, right? The house always wins. The company's gonna put odds out in favor of itself, and over the long term it's going to win the majority of the bets, and it's going to make money on taking bets from clients. So that part of the business is not in doubt. It's just the scaling out part of the business that's expensive, right? Rolling out into new states, acquiring the customers, getting them on the DraftKings platform. Once they're on the platform and they're making bets, DraftKings is going to make money. Believe me, DraftKings is going to make money. The house always wins. It's just a matter of how expensive is it going to be for DraftKings to acquire the customers, and then can it engage these customers to make enough bets to make up for those customer acquisition costs. That's the big question for DraftKings. Finally, I wanted to compare these three growth stocks on valuation to make the decision which one of these growth stocks is the best one to buy. And looking at the forward price to sales ratio, Shopify is the most expensive at 6.955. Next is Palantir at 6.287. Finally, DraftKings is the cheapest and nearly 1/3 the valuation of the others at 2.217. Still, I would not be choosing DraftKings in this decision. I can eliminate them immediately here, and it's between Shopify and Palantir. And right now, the best growth stock to buy out of these three, I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Choose Palantir. Palantir's making progress towards profitability, while Shopify has chosen to make significant investments. That's going to be headwinds towards profitability. And right now is not the time for companies to not be profitable, to be burning through cash flow. The market is less tolerant of unprofitable growth stocks over the near term, as the cost of capital has absolutely soared as a result of the Federal Reserve increasing interest rates and these recent bank failures, and the illiquidity issues at banks is only going to make that problem worse. And so you want to be a self-sustaining company with positive cash flows, with positive profit prospects, and you don't want to be one of these companies like DraftKings in this environment right now. You're not going to find it easy to raise capital. So there you have it. That's my answer. Palantir is my choice of these three growth stocks as the best one to buy. If you like this video, I've hand selected a few videos that I think you will enjoy. So please click on one of those and I'll see you over there. As always, thank you so much for watching.